We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Sam Bates of Bates Capital Group. Now, Sam is actually he's hoteling it today, hoteling, however you want to say it. But we get that a lot simply because as capital raisers, as real estate folks, as everything that goes on, we're moving constantly. And so, Sam, how are you today?
I'm doing great. Thank you for having me on the show, Casey. I look forward to talking to you and talking to your listeners and hopefully share some wisdom and drop some
Absolutely, man. That's
dimes.
great. Well, we all the time, this discussion always starts with, okay, your backstory. Where did you come from? How did you get to where you are? Obviously, is the initial part of this. But then we always seem to find little nuances and caveats that people have gotten into, or maybe some sub markets that people have found that work for them. And ultimately, what we're trying to do is connect something from your story to the listener, and then because we want to kind of take a different angle at virtually every aspect of this capital raising, every aspect of this syndicating, and so on and so on and so on. So anyway, so tell us a little bit about yourself, where you come from, how you got where you are, and then we'll kind of take it from there.
Yeah, and I didn't know what real estate syndication was. I didn't really honestly know what a real estate investor was when I was younger. I grew up in a farming community, very blue collar, and I was always good with numbers. I like math, and so for undergrad, I decided to do finance, and I still didn't understand what real estate investing was, but at that time, I liked the stock market. I thought that was a way to build wealth. I thought that was the way to help people grow their portfolios. So I planned on doing that, and I got an internship with a, one of the largest banks in the world. Loved it. I then accepted a job there and was working as an equity analyst, putting together portfolios to for high net worth clients, typically probably two
Okay.
to 10 million. And it was a great job, but at the time I was out in LA. I wasn't making a lot of money. I'm from Texas. I wanted to go to grad school, so I moved back, went to grad school. I majored in personal financial planning, and they had an MBA program that was a joint degree. When I was in there, the market crashed, and that basically shifted my paradigm. And I'm like, okay, I just saw people I knew. I saw family members lose 30, 40, 50% of their money
Yeah.
virtually overnight. And it left me with a lot of thinking and a lot of just like realizing this wasn't what I
Yeah.
wanted to do full time anymore. So after really 6 years of college, I had to reinvent myself. And I went and interviewed a consulting firm. Honestly, didn't know really what I'd be doing there, but I had some friends from undergrad and grad school that worked there, so I thought it'd be a great opportunity and culture. I quickly realized I did not want to be in consulting
Yeah.
for 40 years. um, I was going from at UBS, I was talking to people on the phone, interacting with people on a daily basis, going to the consulting job. I'd maybe talk to even my teammates sometimes once a week. And it was just reading tons of tax law, oil and gas dictionary. So I quickly realized I needed to do something else. And during grad school, I read a few real estate books, and it kind of sparked my interest. And kind of just through luck, I took one of my TVs to be repaired, and I started talking to this guy. It turned out he was the shop owner, and he was invested in real estate, and he just started talking, and that kind of like propelled, I guess, my um, journey into real estate. And luckily, I'm in Dallas, so there's a lot of real estate organizations, networks. This was before Meetup. This was like 08, 09
Yeah.
timeframe, but there's still groups and groups. So I started surrounding myself with like-minded individuals and just started realizing, hey, you can make a career out of it. You can grow wealth, and seeing people actually doing it
Yeah.
is one thing. And, well, it's completely different because like my granddad was a business owner. My dad was basically a sole proprietor, and they kept saying it was risky and didn't need to do it. So once I saw people doing it, it just helped me jump in full steam ahead. And that was in '09, and really haven't looked back.
Well,
And
so let's chat real quick. So are you in Dallas now? I'm trying to.
yeah, I live in
Okay.
Dallas. Right now I'm in Atlanta
Okay.
visiting a
Well,
property
but
we have.
your
But
hub is in Dallas, right? Okay, good deal.
yes.
Now, how many properties or how many doors, I guess is the way they look at it now, do you all have under management?
Yeah. I started out as a limited partner, and I did a few deals. Then I went and either bought and hold, flipped, fixed and flipped, did spec builds of about 18 single family homes. And I realized that wasn't a way to scale.
Okay.
So then I moved into the GP side on multifamily. And from that, we've developed or acquired over 1,000 units in 4 states. And I'm also a partner in
Wow.
a single family development that we, or single family business we develop. We're on track to do 190 homes this year, and we do land developments and some other stuff. And that's primarily just DFW.
Wow. Man, that's unbelievable. Um, and so I guess tell us a little bit about, so you're currently looking at properties, this is the trip to Atlanta is you looking at properties, right?
Well, we have an asset in Atlanta, so I came down for a conference and also just kind of going and seeing how it's performing right now. We bought it last January and it's done phenomenally well, and just kind of checking in to make sure we third party manage our properties and making sure that they're doing a good job.
And how many doors is there in Atlanta?
That's 134.
Wow. Okay. Well, good. And so you say you have a third party property manager. Any issues or problems with that? Also, I guess the big question is always what do they charge? We got now that may be too personal or too close to whatever, but we're hearing
Yeah.
6-7%. It seems like anymore. But what do they tell us a little bit about that and what problems might be associated with it?
Yeah. Fortunately and unfortunately, I went through a lot of
Yeah.
property managers. On the single family side, I've had probably 7 or 8 property managers, and they tend to charge the 5 to, some will even charge 10%. Um, and then on the multifamily side, we've used, I believe, 8 property managers. Some of it has been just geographically, we want to put the property manager that is in that location with that asset. And then some of it we've had to hire and fire people just because they weren't doing their jobs. But they all have strengths, they all have weaknesses. I think it's really important to vet and to con- conduct a thorough DD on them. And sometimes that's hard because when you're just interviewing through phone, they're going to tell you exactly what you want to hear. So I think going to properties they manage, talking to their owners, talking to people that have been in the industry for a while and might know them, just getting feedback from them, I think helps out
What are
a
your
significant
thoughts
amount.
on, of course, it's probably 60-40, 60% say we want vertically integrated in-house property management, 40%, maybe it's 70-30, 70% in-house, fully integrated, vertically integrated property management, 30% outsourced. I don't want to fool with it. We just pay them. But to me, it's there's a fine line, and you can correct me if I'm wrong because you obviously have the third party property management experience as we all do. But there's a fine line between negotiating a deal with a property manager that's best for your investors and getting somebody to actually perform the duties they are employed to perform at a reduced rate. And that line is typically where you run into issues. Obviously, then it becomes you pay what you get for kind of scenario. Somebody that's going to cut trim way
Yeah.
back and run bare bones, and you're going to almost get a bare bones thing. But for you to be responsible for investor money, is it more responsible for you to pay an extra percent on the property management, say 8% or 7, whatever it is, and then you have to decide where it's profitable, I guess.
Yeah, and that's a really good question. I think each company has to answer it themselves. And like for the apartments and the size of the apartments that we own, we're paying the property manager 3 to 4%. So their margins are razor thin. And also another question I've had with other investors, with my partners, with people, we expect a person making 50 now with labor increases, maybe 60,000 to operate a property that is valued at 10, 20, even 40 million. And from an economic standpoint, it's tough because they base the property value off NOI. So if you're paying somebody 100 or 150,000 to manage it, your NOI is going to be significantly decreased, but you're going to get a better quality manager more than likely. So what we've done, and this has been through with experiences, we obviously want a solid on-site staff, but we look at the regional manager and see how much experience they have, and that helps, and see how busy they are, because some of the shops are kind of sweatshops, and a regional manager might be over 13 properties. We found one group that we like significantly, and we'll probably give them most of our assets going forward, where their regionals are over 4 to 6 properties usually. So they have a lot
On
more
three
bandwidth
at three
and
or
they
four
can
percent
help.
management fee, or a little higher.
Yes, 3 to 4%
Wow.
management fee. And the property will pay for the on site staff's
Oh, then you got
salaries, but
somebody
usually the
one step above. I see what you're saying. I see what you're saying,
yeah,
because the on-site stuff
yeah,
seems to be
and
where most of the problems lie, because that's where the majority of your what would you call, like your problems, your everyday problems are niched way down to what
yeah,
happens on site at 3:30 one afternoon is far more important than collecting the rent for a whole, like, obviously you got a kid that, or somebody that's an arsonist or playing with fire or whatever. You got to take care of that right now. And if you don't have an on-site staff that doesn't take care of or you don't have an on-site staff, then he burns the building down. You have an on-site staff, somebody sees him, stops it
yeah.
right there. I guess that's obviously a wild scenario, but I'm just saying that the on-site stuff seems to be far more important. So collectively, between a regional manager and on-site, whether the on-site folks, you a lot of people give one of their units away for an on-site somebody that just kind of, I don't know, the pool lady, when I was a kid, we lived in an apartment complex. She liked to sit by the pool and drink
Uh-huh.
wine like all day, every day, and that was what she did. But she had a free place to live. Not
Yeah.
free, but I mean,
We haven't given anybody a free place, but we'll give discounts. And like some of the properties will have security guards that are constantly walking and patrolling. It just kind of depends on the
well,
tenant makeup, the
yeah, and it's the
profile of the tenant.
location too. I mean, it's
Yeah, location. But you are correct. Like it is, I think the on-site staff and the regional go in tandem, and it's very important that you have. I think high integrity people that do their job is very important. And like one asset we bought, I should have went with my gut and I didn't. But I walked in and I met the on-site manager, and I just got a bad feeling about it. And we had used a property management company before, so I trusted them. And I was like, okay, you believe she'll do a good job. Well, we'll leave her in. And 6 months later, we fired the management company because they wouldn't replace her and she wasn't doing a
well,
good
and
job.
let's be honest,
And
there's so many companies out there that are trying to stand between us as employers, uh, like for instance, I guess what I'm getting at is let's look at the resume companies. Like let's go with just the big ones that we know of. If you want a job, you post your resume on these websites, right? All right. Well, they have such a profitability model that it's making it really difficult for people like me and you to get through to the people we want to get through to and actually have a pool that we can pull from and say, hey, let's
Yeah.
interview these 10 people. Instead, you're getting people that are not qualified for anything that are applying, and it's making it really hard to get a pool of people that are qualified to do what you want to do, and that you can go in and interview 20 of them and say, oh man, look, this guy right here or this girl right here is exactly what we need. And so it's almost like a headache, really. And then by the time you spend a 10-hour day searching to hire a person that's going to make $50,000 a year, it's just like it makes you want to pull your hair out. You've burned all this time, and now you're at where you want to be, and now you got to fire them or whatever.
Yeah, and I think from an asset management perspective, that's where it's key to continually have the relationship with the property manager. Like we have with all our managers, we have weekly calls. Sometimes we're talking if we're in like a renovation or lease up or some phase that's labor intensive and not when we're stabilized, we're talking significantly more than once a week. And you can figure out you can kind of sift through some of the BS that they're telling you, or you can determine that they aren't
Yeah,
a good fit, and you can quickly make a decision. Like right now, we're doing a large renovation that's roughly $4.6
yeah.
million in renovation, and we've learned that the contractor is probably not the best fit, and this week or next week we're probably going to have to release some of his duties. But we've seen it and we realize he's over his head, and that's just because we've been talking to him on a weekly basis and stopping by the property on a every once or twice a
Well, and
week,
that comes the
and
same.
seeing
Those are the same models that tend to bite you in the rear end as the property management that we discussed. Time you have a decent contractor that comes in and they're like, man, I'm 10% of the gross spend or whatever, and you're like, my man, what? I'm not paying you X amount of dollars to do, X amount of huge dollars of your investors' money to do this. We're going to go find somebody that wants to do it that'll do it cheaper. It's a double-edged sword. It always ends up being, where is it responsible to spend investor money a little bit more, and then it just it's the whole caboodle of everything there that you have to be so careful of. So hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cashflow Pro part of your day. Now, back to the show. So you mentioned
yeah.
there you're doing a renovation. Tell us a little bit about that.
This is by far the biggest renovation project we've done, and we have a lot of experience. We've probably done 7 or 8 ground up developments. We have 2 more in the pipeline, but these are in a good location in Dallas. It's actually a 3 property portfolio that was built in 34, 37, and 73, and the units basically just need completely
Yeah.
being gutted. When we were walking it, we bought it directly from the seller off market, but when we were walking it, there was meth
Oh
units, there
wow.
was drug deals going on. The seller was the stereotypical slumlord and just let anything and everything go on. So we're having to come in and put $40,000 to $50,000 per unit in to get it up to the standards where we need it to be. And they are very close to downtown. So once we do renovate it, they'll be basically brand new, and we can attract that younger professional that wants to live close to the center of the city because they work there or their friends are there. Just all the
Yeah,
life
yeah,
is there.
yeah. And now where is that at?
It's there's three properties in
Okay,
East Dallas. It's really close to downtown and in the I guess the young professional area, but they're by far the eyesores
sure,
of the
sure.
neighborhood. So once we turn them around, it should be great
Now,
assets.
you said they were refresh my mind. I was thinking about some other things you were talking about there. What years did you say they were built?
1934, 37, and
So
73.
yeah, I mean, man, you're almost tearing plaster walls out basically if you're getting that deep. I mean, the little shims and the slabs, then they put the mud over top of it. I mean, that's a wow, interesting. Um, at 4.7 million, how many units?
It's 110.
And
So
well, I mean, and how much do you think you're gonna? What's your total projection look like there?
well, we bought it for roughly 11.2, 11.3. Put in that. Once we stabilize it, we think the stabilized value will be close to 20 million.
Wow.
Um,
And did you
so
what type of a raise
there's,
did you do for that?
um, well, at the very end, we had to bring they changed the terms at the very last minute because the lender realized it was much more of a heavy lift than we thought. So we were anticipating raising about 4.5 million, but our final equity raise was roughly six.
4.6,
We had to bring about no
6.
6 million. We had to bring about one and a half additional the last week to
Oh
close.
wow. My gosh. Now, did you already kind of have that soft committed in any way, or was that basically just bare bones? Hey, let's go after it, or what?
It was both. Luckily, this raise we oversubscribed within like
Okay.
48 hours. So we did have a list of people, but that was probably almost 2 months after we started the raise. So some people were still interested, some people weren't. So we were having to pick up the phone and call and email and see if the people that were on the waiting list still wanted to
Now
invest or not.
that brings up an interesting point, and I'm sure you probably have no idea where I'm getting ready to go with this. So, uh, but you said that that was a couple of months into the raise, right? Now,
Yeah.
and you mentioned this was an off market slumlord kind of deal that you purchased it from. Now, when you were negotiating with the owner, what was your closing timeline like, and how did you position yourself when you presented to him that, hey, because here's the thing, a lot of times off market sellers, individual owners, people of whatever that just own or inherited or whatever a 150 unit complex, let's say, like what you're talking about. They don't understand. You have to go in and almost basically educate them and say, hey, man, listen, I want to buy this, but listen, I need some time because I'm going to have to raise this much capital. Then I'm going to have to go do this, and I'm going to go do that. So how was that positioned from the standpoint when you first approached him and said, hey, we want to buy this, but
That's a really good question. And we actually had a pre existing
okay,
relationship with him, so that helped significantly. And he knew it was in bad shape, but once we started due diligence, we were able to uncover
just how bad
just
a shape it was
so many
in.
more issues. Yeah, and either he didn't disclose it to us or he just
Wow.
didn't know. It could have been a little bit of both. And so we were planning on closing last September-ish, and we didn't close until end of last year, just because once we got in, we had to bring in more people for due diligence. The lender had to come back and inspect it multiple times. We had to go through multiple rounds of price reductions,
And
and
each one
it
of
was
those is
just
like negotiating for the first time.
Exactly. And we dropped the price by almost $2 million from when we started to where we ended up. And it was always a tough negotiation. And I think if it wasn't for that pre-existing relationship that we'd had for 6 or 7 years, either we would have pulled out or he would have pulled out. But we knew it was a good deal if we could get it at the price that we needed
Well, and
it.
basically
And
when you're
now,
talking about due diligence, you're not like, "Hey seller, we want to buy this for $2 million less." You're basically going to the seller and saying, "Hey dude, I got $2 million worth of repairs over here that you didn't tell me about, and now I've got to figure out a way to invest to convince my investors that this is still a good deal." Or even the seller has a little bit of a liability on them to explain to you why you should continue this purchase when you've got all this extra stuff that has to be done. And
yeah,
somebody the other day was telling me about a $250,000 sewer issue that they uncovered in due diligence, and I was like, "Wow!" That otherwise, then you got to eat that at some point if you don't do that. So due diligence can be really. I mean, obviously, we all know how important it is, but if you can get somebody that's reasonable that says, "Hey, I'm going to sell you this for this price. Do your due diligence. Let's both be reasonable." And it sounds to me like at the end of the day, that's what you all ended up with was somebody that knew, hey, it was in bad shape. And a lot of times the thing is that it's kind of like when, from the real estate sales business, it's a whole lot different when I come in and I'm ready to sell your house because that you brought your kids home to when they were born, because your house is a commodity to me. You're emotionally attached to it. And so when you have a seller like that you can really just kind of work in there and say, hey, this is what it is, what it is, then that's a little different. So, well, anyway, well, good, man. That's great. Well, congratulations to y'all on getting that deal done and closed. And you're right though, man. That sounds like a heavy lift. Is like I guess,
that's
yeah,
an
it seems that
understatement. I
way
feel
for
like it is.
sure. Well, we
But
certainly be glad to see the end result when you get finished and just show the people and your investors now the $6 million raise. How many investors was that?
that was 42.
So
So it's actually one of our larger um,
yeah,
investor pools or raises with investors. We've done larger raises in the past, but that was one where we initially thought we were going to be bringing 4 to 4.5 million. Then it turned out it was a lot more.
and
So we're scrambling
where
kind
were
of
you?
in.
How do you build your lists of potential people? Just through social media or 506B or
We're
C? I
just
guess first off,
it. Most of the time, we've always done 506B. We're just starting to grow our list through social media. That's honestly, that's probably our Achilles heel at this point is not advertising. In the past, through business relationships, luckily we've been able to make a lot of connections with that way with business owners, just friends over the last 10, 15 years. Now the last few years we've been getting referrals. So it's been growing, but this year we've made more of an effort to get on social media. We're looking at crowdfunding options. We're looking at different placement agents to raise a fund potentially. So just looking at all different
sure.
areas at this
Good
point.
deal. Well, all right. Well, Sam, listen, we're getting towards the end of the episode, and I've got a couple of questions that we ask every guest that comes on the show. There's no right or wrong answer, but the first one is, what is the best book that you have recently read or are currently reading?
I would say the best book that I recently read is last year, but it was Who Not How.
Like
And
the sixth time in 2 weeks I've got that. So,
yeah, and it's a simple read. It's common sense, but it honestly, I guess it's
it
just
kind of
getting
pulls your
reinforced in your
wandering mind
brain.
back where it should be in a way.
Yeah, exactly. And it helps you realize you shouldn't do anything. You shouldn't do everything, and you can't do everything. And like we went basically from me and two partners to over 50 employees, and that was a big shift. I think definitely for me, and I think for the other guys that we have to start delegating to
Sure,
grow the
sure.
business.
Yeah. Well, good deal. Now, what is a dream vacation that you have either taken or hope to take?
Oh, one of my hobbies is traveling, so I love to travel. I, During COVID, I was supposed to go over to Budapest, Prague, Bratislava,
Yeah,
and Austria. So I guess I'll say that maybe it's definitely a dream vacation. Might not be a top vacation, but since that was on my mind a couple years ago, I definitely want to do that again
cool deal, man. Well,
or
good. Well,
experience.
listen, so you had mentioned, you all are looking towards moving in the fund direction or placement agents and so on and so forth. But if there's a listener out there that heard something that resonated with them that maybe they want to ask more questions about, or even potentially be an investor with you at some point, what is a good way for people to get in touch with you?
Yeah, definitely. I love talking to people about real estate. It's a passion of mine. So you can reach me at sam@batescapitalgroup.com and we can set up a call or exchange emails, whatever you feel
Good
is your
deal. Well,
preference.
Sam, thanks for being with us today. We really appreciate it. And listeners, if you don't mind, to go give us a review and give us a 5-star review. We hope if you like what you've heard today and you like what Sam had to pass along, you can always, he just gave you the way to reach out to him. So we do, as always, we do appreciate you listening and hope everybody has a wonderful rest of the day. Sam, thanks again. Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.